back. My name is Trent. I'm Risk Management Advisor for Comark Equity Alliance here in Oklahoma, and today I'm joined by Matt Hartwell. Matt does the same job as me, but up in Kansas, and we thought today would be very interesting to go over this wheat crop that we have coming up. You know, Matt, there's a lot of potential out there, and I think that farmers are getting out there and investing in this crop and spending some money on it. So can you tell us what you're seeing in southeast Kansas and right there around that Wichita area?
Absolutely. So, Trent, I wondered, with the price declining as it has compared to the last 2 years, are farmers still looking at pouring the inputs on when we're looking at, prospectively $5 or $6 wheat as opposed to $7 or $8 or $9 wheat? And definitely through top dressing season, we've seen them, aggressively not take away that top end yield potential, whether it's putting in a heavy dose of dry urea or split nitrogen applications in the form of UAN. They're giving the crop its maximum potential, and I think hopefully maintain that mentality and get through the fungicide season and that sort of thing. So definitely something that we like to see as far as not giving up on the crop and
no, I totally get it. And that's one of the things, like back from my extension days when I used to work with farmers, I would say there's a whole lot of things you cannot control in this world. Prices are going to do what prices are going to do, and we'll get into some of the fundamentals we've been seeing in world markets and why wheat and corn and soybeans have all felt a little bit pressure here lately. But one thing as a manager and a producer on your operation that you can control is yield. I mean, of course you have to have water, and that's one thing that Mother Nature has blessed us with this year. Is it seems like we've been getting decent rains, and it's good to see that producers are really investing in that crop, and we can certainly hope that that's going to improve the quality of this crop and of course the yield. But I kind of alluded to that fundamental situation. We've seen markets slip into kind of a long decline here, and you want to touch at all on why you think that might be the case, especially that wheat market?
There's a lot of factors in play. I mean, the export situation and the demand situation, both domestic and abroad, has continued to weigh heavily on the market. We just haven't been in a great demand situation, and that's kind of been an ongoing struggle for the markets to wrestle with. Demand from a domestic perspective as far as milling is relatively inelastic, but we aren't getting that support from tenders coming in from countries abroad and offering to buy our wheat. Then you have the funds, and you always see spillover pressure when the funds drag corn and beans down. A lot of times wheat kind of gets dragged down with them, and we've definitely seen that this spring. So multiple factors in play, none of which unfortunately have been on the upside, but we have seen some opportunities for producers to lock in prices on some short covering rallies. So even though the funds do get short the market, there's always some corrective actions, and you might have a little bit of a weather market. You might have them just kind of rebalancing their balance sheet, but those can provide some near-term selling opportunities for the farmer.
Yeah, and I know earlier this morning you and I were talking about just simple market economics, what makes the market go up and down. And I thought breaking that down to an elementary level, whenever more people want to buy, you see the market go up, and when more people are interested in selling, you see the market go down. So we definitely have a pretty decent sized short position out there in commodities right now. And I guess like yesterday we saw the market rally pretty well, and some of that was attributed to short covering and those funds unraveling possibly some of that short position and buying into the market. But one comment I saw was that there's a mountain of corn sitting out there, a lot of corn sitting in farmers' bins and sitting out there in storage. And the comment was, why would the funds want to buy more corn than is out there available for sale? And that makes perfect sense. It seems like the farmer is rewarding some of these rallies and selling corn into those rallies, and then that puts kind of a lid on the potential for that market to explode for us and move to higher reaches there. I was looking at doing some charting here the past few days, and some of those price levels that we've been testing are support from back in 2020 and 2021.
Yep.
So I don't even know if I can call that support. It's just something to go back in time. I got to build a 5-year chart and go look at the last time markets traded down to this level. So it becomes scary for the producer a little bit. What is the floor in this market? What can keep it going up? And we might talk about some of the vehicles or the avenues that we can take here at CEA to kind of provide some risk management there. So have you been able to talk with farmers and get any risk protection avenues established for them when it comes to wheat?
We have made some headway there, and I'll kind of backtrack to talking about the support levels that were established from several years back. In a lot of my conversations with farmers, I kind of find it useful to encourage them to maybe throw out the last 2 years as far as their frame of reference, as far as what are realistic price targets. We had some unprecedented volatility with instability in the Black Sea region and just a lot of speculation in the markets, and we saw some really high highs, and now we're seeing some lower lows as a function of some of that volatility being taken off the table. But when you look back to what are long-term realistic price targets for the farmer, given their production budgets, given kind of the current market environment, there's ways that they can lock in futures with or without locking in the basis with their contracts, and basically it's just a matter of a lot of times it's useful to set those offers out so they're working on an ongoing basis. So if maybe there's some extra volatility in the futures market during an overnight session, they might be able to snipe that extra nickel or dime that might not have been realized during normal trading hours. And that's definitely a strategy that I encourage folks to employ. If they have kind of a number in their head of this is a futures price, that I would feel good about getting locked in for a certain quantity of bushels.
Yeah, I think a lot of people know about that, but then again, I always run across people that don't. And those working offers are incredibly powerful, because we see some crazy stuff happen in the overnight markets. We're all asleep. We might see corn spike 10 cents for no reason at all, and that's just a way. We talk about kind of mechanical trading strategy sometimes as taking emotion out of marketing and just getting something out there that makes things happen for you. And I love offers that way. It's like, give me a pie in the sky number. You think, all right, what's the highest you realistically think corn will go to in the next year, or whether that's wheat or whatever, doesn't matter. And let's get an offer out there and get it working. And we can divvy up our expected production that way and get it working in different vehicles. You got purchase contracts where you set the futures and the basis. You got a basis contract where you're only setting basis, and then you got hedge to arrive contracts. And those are just setting futures and leaving basis open, and you can set that basis at a later time. And you can put offers on any of those contracts, and there's a lot of different things we can do to help producers kind of work that market and try to get the best price that they can.
Absolutely. I kind of look at setting offers as a producer playing by the same rules that the rest of the market participants are. Mm-hmm. So, the funds that are highly involved in the market are using that degree of automation in their trading, and it kind of only seems fair that the producers utilize some of those same strategies so that they can, participate to the ends of their goals. Yeah.
Yeah, and I like that topic that you were on just a little bit ago, where you were speaking about realistic price goals and what we've seen the past few years. And I did a meeting out west back in January, and I cautioned them, like the thing I built this whole presentation around was cautioning producers against thinking that this is a bad price that we're looking at right now. Like, oh, it was so much higher last year, it was so much higher 2 years ago, this is a terrible price. And that's totally understandable given inputs. And I can already hear people in the background saying, yeah, but our inputs are a lot higher, and it's costing a lot to farm, and I totally understand that. But at some point, if we're going to be really good managers of our operation, we just have to deal with the constraints that are given us and work within that. And I always say the best thing you can do to manage your farm is to grow as much as you possibly can, market that information that you know about your own farm. That's one of the benefits of forward contracting, especially to a company like CEA, is we get a better idea of what that crop is going to be. And when you have producers making promises of delivery, that helps the market understand that crop and how it's coming in. All information is valuable, and as we move through time, that working in that relationship and working with us as risk management advisors, and Mike, our risk management advisor director, we try to go through that, look at your crop insurance guarantees, understand what you are sure that you can cover in terms of a forward contract, so you're not getting yourself out there in a situation where you're having to buy back bushels in terms of a crop failure that you don't have funds to cover. And we try to be really cautious about that, especially this far ahead of harvest. But as we get closer to harvest and this crop becomes more known, getting more aggressive and thinking, even if the decision is to wait till after harvest to market, have a reason why you're making that choice. Whether it's I'm not covering my break evens, or I have a good understanding of markets and I think that there's a good possibility of that going up. That's selling information, that's utilizing information, and I think it's incredibly important to just have that plan. So that way, whenever the time comes and you see a good price, you know what that looks like. Oftentimes, say the wheat price does get back to $6, there will be many, many producers out there that don't do anything. And if it goes back down, they'll say, oh, if I would have just done something at $6, that was a good price. But I think thinking through that early on, what is your good price? What is that number that gets you excited to market that crop? And then have some type of mechanism in place to take advantage of that.
Right. Yeah, I think one of the things that's really exciting to me about this 2024 production year is there's a high prospect that we're actually going to have bushels to manage risk on.
Yeah.
I mean, that was a huge frustration for producers over the last 2 growing seasons. In my trade territory of South Central Kansas, there was some pie in the sky prices in play, but there really wasn't bushels to apply to those record high prices. And so the fact that there is good prospects of production, and we're continuing to get the rain and maintain that yield potential, kind of elevates the need to proactively manage that risk through some sort of whether it's executing price floors or just setting targets out there as to price points that would be acceptable revenue.
Matt, I'm super excited about this upcoming wheat crop, and I think we're definitely going to have something out there to market, which is different than the past few years. But what we have worked through in the past few years is dealing with buyouts or rolls. And I was wondering if you could kind of walk through some of that terminology and how a producer would either buy out or roll, whether it's be a hedge to arrive contract or a basis contract.
Sure. We definitely have mechanisms in place to address that. Obviously, we want to see the producer's production fulfill their contract, but we know things happen, and we definitely don't want to kick a producer when they're down, so to speak.
Right.
So we have a really simple formulaic approach to buyouts. We have a flat buyout fee, and then we take a calculation based on that differential between where the futures is at, when they made that contract and where the present market's at. So it allows the producer to, effectively wash their hands and move on down the road. Mm-hmm. With that simple approach to the settlement, makes it not a lingering issue, and just allows them to kind of say, okay, this is the formula, this is how we can clean things up, and then be able to move on down the road with it.
Yeah, I mean, that's the important thing, is we want producers to focus on producing bushels and harvesting, and if it becomes a situation where we can't fulfill those contracts, we definitely have the mechanisms in place to take care of that, and we're more than happy to help you work through that whenever that occurs.
Yep, just a phone call away there.
Yeah. Well, Matt, we've covered a lot so far, and I think that's a really good place to kind of put a bookend on this thing and move forward. Is there any last positive advice that you want to give our producers?
Well, I'd say, going through the next couple months leading into harvest, just continue to keep an eye on the markets. And once you've identified those pricing opportunities, we look at weather as a trigger. We look at fund activity, mainly short covering, as a trigger for those pricing opportunities. Just try to keep your eye on the ball and take advantage of some of those opportunities as they present themselves.
It's outstanding. Well, thank you very much for watching and listening in today. We hope that you found something useful that you can definitely take into this new crop year and help better improve your grain marketing strategy and those mechanisms that CEA can help you with to lay off some of that risk as we move into the new crop year. We'd like to remind you to like and subscribe if you feel free to do that. It really helps the channel if you would like that, and hit that bell notification so you're aware that whenever we publish new videos. So, Matt, thanks again, and we'll see you later.
Sounds good.